here today listening to the Your Financial Maven podcast. It is tax season for me. Officially, tax season opens up for the IRS on Monday, January 26th, where you can begin to start e-filing your returns as long as you have all your documents. I am in the state of Pennsylvania. We are gearing up for Winter Storm Fern. As I record this, it is Saturday, January 24th. Also, shout out and happy birthday to my mom. Hope you have a great day. She is in sunny Florida, not having to worry about these very cold temperatures and the snow and the sleet and the ice that is on its way. Hopefully, everybody will stay safe and warm, and hopefully there won't be too much with power outages or too much damage from this storm. So, wishing everybody in the path of Winter Storm Fern good luck and stay safe. All right, so why am I here today? So it is, like I said, it's tax season, and the IRS actually yesterday came out with more guidance and clarification related to the overtime deduction. So back in July of 2025, the OB3 tax law was passed, and in that it talked about no tax on overtime. And as I have stated before, and as I will continue to state, it is really a deduction. What does that mean? You still have to report your overtime income on your tax return, in your pay stub, and you still get taxed on that income. It is still taxable income. What this means is that you potentially could get a deduction. And that is something that needed clarification. The law passed in July. Typically, clarifications come out September, October, November. The government did shut down. There was some delay. And the IRS is now starting to come out with more clarifications on different things as we gear up to prepare returns and submit returns. So I'm here today to give you a little bit of a summary, a little bit of an insight on what the IRS released yesterday. I will leave the link to their release notification. I'm also going to be quoting and summarizing. I follow the real tax girl, Kelly Phillips Erb. She writes for Forbes magazine. She is out of the Philadelphia area. She is also a tax attorney. So it's really nice to get her viewpoint on this. I do follow her on Threads and on Facebook, have a connection, and I absolutely love doing that. And hey, Kelly, maybe at some point you'd love to come on Your Financial Maven. So maybe we can get you on here and we can talk a little bit more, maybe after tax season or somewhere in the middle. But anyway, let's get back to why I am here today. So I'm here today because, like I said, overtime. So what I'm going to do is and I have my notes, my trusty notes, as a lot of CPAs and enrolled agents and tax accountants will tell you, having our notes and our books with us is very important. When I was in college going for my accounting degree and I took my federal income tax classes, they were open book tests because tax law changes all the time, different things, there's little nuances, and you want to make sure you're getting that right. So it's always good to have your guides, your tax guides, your information there. Yes, we have AI, we have ChatGPT, different AI tools that you can research, but you really need to go back to the source documents, the IRS, different tax legislation and laws. So that's why I have my notes in front of me, because I do want to make sure that all the information I'm giving to you is as accurate as I can be, given what was just clarified. So the first thing that I'm going to let you know is the deduction itself. So the deduction itself, so for single taxpayers, could be up to $12,500 of a deduction on your tax return. Married filing jointly, up to $25,000. And the reason why I'm emphasizing married filing jointly is if you file separate, married filing separate, this deduction, in fact, all the deductions in the new law do not apply to you. And that is typical when you file married filing separate. So you really, really have to be aware of that. The other nuance with this, as well as with most of the deductions and credits and tax legislation that was passed, is you must have a valid Social Security number in order to get these potential deductions. And with that, your name on your Social Security card has to match what is your number, because if you file it, it will get rejected immediately if they can't match the name to the number. And I have seen it happen. I've been doing accounting and tax for over 30 years, last 12 and a half years on my own, really focusing on tax for small businesses and individuals. So I've seen it. Sometimes that means there's potential fraud. Somebody else could have filed your return. But 9 times out of 10, if the Social Security card does not match the name on the return, it gets rejected, and then you don't get your deductions until you fix it. So if you're married filing jointly and one of your spouses or partners does not have a valid social security number, but they have an ITIN number, they cannot get this deduction. So it's really important to be aware of that. And that's for all of the information that was passed through the OB3. So that is the potential deduction. Now, it could potentially be changed or reduced based off of your modified adjusted gross income. If you are single and it's $150,000 and over, or married filing jointly $300,000 and over, you may not potentially be able to get this deduction, or it's reduced. You won't get the full amount in that regards. So the other thing that what the IRS really clarified was who qualifies for this overtime deduction. It's really important to know that this is related to your premium part of your overtime that is covered under Section 7 of the I'm going to say this right, the Fair Labor Standards Act, FLSA. So there is a qualified overtime premium that if it qualifies under FLSA, and you meet some of the other requirements, you may be able to get this deduction. So there is transition. So this goes from 2025 to 2028. You will potentially notice on your pay stubs for 2025 and your W-2 that it is not clearly broken out because of when the law was passed and not having all the documents updated. Employers and payroll companies are required starting in 2026 to have that breakout. So you might start seeing that on your pay stub. So what does that mean? Well, that means if it's not clearly broken out, so it could be on the W-2 in box 14, but if it's not clearly broken out, you're going to have to go back through, ask your employer maybe for any kind of spreadsheet they may have, look at your pay stubs, and you'll have to go back and figure that out. If you're working with a CPA like myself, an enrolled agent, a tax preparer, you're going to have to give them that data so that they can take the time to figure that out to see if there's a potential deduction. The same thing goes for the tips deduction as well. Hopefully your payroll stubs and your W-2s going forward will show. They are required to show. So of course for employers, there is relief. There is relief on the penalties for not doing it for 2025 because we're in transition. But once you hit 2026, it is required to do that to avoid any kind of penalties in that regards. So those are the highlights, the overview in a sense. But I want to go back to what actually qualifies, what wages actually qualify. And like I said, it has to be part of the FLSA, the Fair Labor Standards Act, Section 7. And what does it mean? What part of the overtime does that mean? So typically, if you get paid overtime, if it's time and a half, if it's 2 times or 3 times for overtime, it's the half piece. It's just the half piece. That's the piece that could initiate this deduction. So if you get 2 times overtime, it's the half piece. So that means 1.5 of your 2 times overtime is not part of the deduction, just the half. So it's really important that you know that it's the half time rate of your overtime hours that potentially could qualify for this. The other thing is, and the understanding is that the majority of employees in the United States do qualify in the sense that they fall under the Section 7 FLSA overtime qualifications. There are some federal and state employees that also qualify. There are employees that don't. There are employees in certain industries that do not qualify, like lawyers, accountants, some in the pharmaceutical area. If they get overtime, doesn't matter the reason, they most likely do not qualify for the deduction. So it's really important to take a look at the 2 links I have from the IRS and from Kelly Phillip Herb's article to see what those qualifications are. She really goes into nice in-depth summary for that. So it's really, really important. But I will quote her from her article, and she does say that eligibility is facts and circumstances specific and depends on factors based off of your occupation, your job duties, your earnings, and where the Department of Labor qualifies all that. Of course, there's a link for that as well in her article and on the IRS website. So it's really, really important that that you have that information to know what is qualifying. And like I said, there are certain, unfortunately, businesses, employers, areas that potentially do not get this qualification regarding that. So it's important to be aware of that. Also, independent contractors, seasonal workers, farm workers, etc., may potentially not qualify because they're not covered by FLSA, and then you can't receive this overtime compensation. If you have overtime compensation in those areas, you potentially do not get this deduction. So there are different levels that you have to be aware of. And like I said, I will have all the links down there for you to know what's going on. And I did mention, like I said, what the amounts are, what the potential deductions are. The other thing to note again, and just to remind you, you still have to report your overtime. There's still tax on your overtime. This is from 2025 to 2028, unless a new tax law comes out and makes it permanent. Remember, anything that is permanent from this tax law or any prior tax laws that has not been changed remain permanent until and if they are changed or scheduled to be done. How does this work on the tax return? So the IRS has created a Schedule 1A for all of the new deductions for the OB3 tax law that was passed back in July of 2025. So all of the information, if you have overtime, tips, Social Security deduction for 65 and over, car interest, all that will get summarized on Schedule 1A, come to a total, and then whatever that amount is, if there's any reduction because of modified adjusted gross income or other things, will then flow through to the 1040. I think it's going to be around line 13 is where it'll be on. The other thing to note is you can't double dip. What does that mean? You cannot take overtime and the tip deduction for the same income. Meaning, let's say you work overtime, you have your half that is qualified, and in that half is tip income. So you're either going to have to leave it in the overtime deduction or pull that out and show it for the tip deduction. I believe based off of this, you probably can take both deductions, but not on the same dollar amounts. And that's where the double dipping is coming into play. So you really have to do the math. You have to work with your tax professional, CPA, enrolled agent, if you're using them, to determine, is this income all overtime or is there tip income in this, and how that works for the deductions. And there might be a little bit more clarification on that, but usually you cannot use the same income for one deduction and also use it for another deduction that is double dipping. So that is really, really important to be aware of that. And I'm just looking through to see if there is any other things that I want to point out. Like I said, please read Kelly Phillips Erb's article that I have a link to, where she talks about the overtime and like I said, the article is called IRS Offers More Information on How the New Overtime Deduction Works. I will also leave the link for the IRS so you can take a look. There's also links for Department of Labor there, and also for the Federal Labor Standards Act, so you can read up on that if you are interested. And just as a reminder, like I said, and I think I mentioned this already, payroll companies hopefully have already started to separate things out. So hopefully you will be able to see that on your W-2. IRS opens up January 26th. You should receive your W-2 by February 2nd, and also any 1099 NECs or miscellaneous forms, you will have to receive those by February 2nd, because January 31st is a weekend. So you will look to receive those, and then you can start filing. Like I said, I would wait until you have all your documents. If you are a partnership or a shareholder in an S corporation, you need to wait for those K1s before you can file. Wishing you guys all a great tax season, easy filing. And for now, I'm your Financial Maven.
The purpose of this podcast is to provide general information on the subjects discussed. It is for educational, informational, and entertainment purposes only. It is not meant to resolve your specific financial needs or situations. Please consult with your CPA, tax, or financial professionals. Follow, like, and subscribe to Your Financial Maven wherever you listen to your podcasts. And make sure that you leave your money stories or questions for me at www.yourfinancialmavenpodcast.com. I cannot wait to hear what you have to say about money.